Good morning, and thank you for joining me. In today's webinar, we will discuss all things ETFs. And this morning, we are particularly excited to have launched our 11th ETF on the Johannesburg Stock Exchange, and a listing on the secondary A2X exchange will follow soon. Before I get into some of the details on this new ETF, which is a global ESG-focused ETF, I want to provide some of our listeners with some educational material around ETFs in general. So I will start off with explaining what ETFs are, how they came about, and I'll take you through our full product range, and then I'll go into a little bit more detail on our new product. So what is an ETF? An easy way to explain what an ETF is you could think about it as simply a unit trust that is tradable on a stock exchange. So essentially, it's a product that is composed of a basket of assets, and these assets could be shares, they could be bonds, they could be tracking the performance of a single commodity such as gold or platinum. And if these underlying assets perform well, then your instrument, the ETF, will perform well. And of course, the opposite is also true. So how did ETFs come about? Well, passive investing became popular already way back in the mid-1970s. But back then, it was done by mutual funds that were very complex. They were very expensive at that time. There were illiquidity issues. And these kind of issues then prompted the industry to develop a different and a better, more accessible product. And that is when the ETF was born. And the first ETF was launched back in 1990, and it was traded on the Toronto Stock Exchange. Today, we find ourselves more than 30 years later, and ETFs have become one of the most popular investment vehicles for both institutional and individual investors. They offer many, many benefits, which I will touch on. And the growth in both the number of products available out there, as well as the assets under management in ETFs, have grown enormously. Today, there's over $7 trillion invested in ETFs across the globe, and there's close to 8,000 different products out there. So it really is an instrument that has just become very popular, and this growth in the number of products and the number of assets under management is only set to increase. As a visual representation, this just shows the growth of both the number of products as well as the assets under management of ETFs right up until March last year. Just to give you an indication, in 2020, in just US listed ETFs, there was more than $500 billion that was invested in US listed ETFs. And in the first quarter of 2021 alone, there's almost $250 billion that has flowed into US listed ETFs. So this is just to show you how, big the ETF industry is, how popular these products are. So if some of you today that are listening to me have never invested in the ETF, then I really encourage you to do so. Even if you just start with a very small amount and you can monitor your investments, really just start today. So I mentioned, or the way that I described ETFs is you could describe them as a unit trust that is tradable on a stock exchange. Well, if we had to compare ETFs and unit trusts, both investment vehicles have their advantages and disadvantages, but just broadly speaking, some of the advantages of ETFs over unit trusts are that because they trade on stock exchanges, they can trade continuously throughout the day. So you could buy an ETF at 11 o'clock, you could buy an ETF at 1 p.m., you can trade them throughout the day. So that means that if you wanted to implement a certain investment decision, then you're able to invest or disinvest very quickly, get in and out of the market. You can also access ETFs via platforms, or if you had a stockbroking account, you could simply search for the share code and you could buy it via a stockbroking account as well. The liquidity is guaranteed by a market maker. We use a very good market maker, which I will touch on a little bit later on. And the same Cisco rules apply to ETFs and unit trusts. Some of the disadvantages Stockbroking charges do apply. Of course, for some of you that may have your own stockbroking accounts, you'll know that when you're buying a share, then you do get charged stockbroking fees. So buying an ETF would be the same. You would simply go into your stockbroking account, purchase that share, and those charges would apply. And then because it trades on an exchange, the price is also subject to the forces of supply and demand. So over here, I've listed it as a disadvantage, but you could also look at this as an advantage. So, of course, if there's a lot of demand for a certain share, we know in the markets that can push up the price. And likewise, if a lot of investors are selling a certain stock, then demand goes down and the price would go down. So an ETF, those forces of supply and demand do affect the trading price, whereas unit trusts are always priced at the actual market value, and that's based on 3 p.m. pricing. So these are just some of the nuances between the ETFs and the unit trust. So why are ETFs so popular? So we saw the growth in both the AUM and just the number of products over the last 30 years that these instruments have been available to the investment industry around the globe. So why are they so popular? Well, there are many, many benefits, but if I just touch on, the 3 main ones, in my opinion. Firstly, it's costs. We know that costs can really, they really influence your true investment experience as an investor. It's all good and well if you can get a really phenomenal return from a certain investment, but if the cost of that investment is a lot, of course, you as an investor have the net of fees experience. So the lower the fees, the more of that return you can actually enjoy as an investor. So ETFs are passive investment vehicles. They simply track a certain index, and for that reason, they are very low cost instruments. So many good ETFs out there have very low costs. Then, as I mentioned when I spoke about both ETFs and unit trusts, the ETFs are very easily accessible via various platforms or through a stockbroking account. If you are invested in an ETF that is tracking a global index, it's a really great way for South African investors to gain global exposure without worrying about exchange control. And there are, of course, other benefits when it comes to taxes, to diversification. When it comes to diversification, you are buying one instrument, but that one instrument it's a basket of securities. And of course, just simply the fact that you are invested in a vehicle that's composed of a number of different securities. That in itself is diversification. There's transparency. At any stage, if you wanted to know what exactly are the single stocks in the index, you could go log onto our website, you could download the fund list of constituents, so there's full transparency. And when it comes to fees, so I mentioned that, of course, these are passive instruments and they are very low cost. And fees, as I mentioned, are really important to the investors. And on this slide, we can see the impact that fees can have on your investment return over many years. So this is an extract from a paper that was prepared by National Treasury back in 2013. And it really aims to show you how higher fees translate into significantly lower benefits at the end of the investment period. So in this case, we are thinking about, in this paper, it was about retirement funding and how if you are able to reduce the cost of your retirement fund investment arrangements, members can expect to receive a much higher benefit at retirement. And the findings of this paper were that if a regular saver who's able to reduce the charges on the retirement account from 2.5% of assets to 0.5% of assets, very easily doable if you're investing in passive strategies, then the benefit at retirement would be 60% greater after 40 years. So you can really see how the effects of compounding, and if you have lower fees, ultimately the benefit over the long term is higher. So why would you invest in Sygnia's ETFs? Well, at Sygnia, we do have a very long-term track record of passive investing in general, and we strive to innovate the whole time. And if you look at this timeline, you can see that back in 2003, we fully replicated an equity index tracking fund, also a bond index tracking fund. In 2008, we launched the property index tracking fund. Back in 2016 was when we first launched thematic passive funds. So thematic investing is when you think about a certain theme that might play out in the future. So think about, technology, robotics, artificial intelligence, and you invest into that theme. So in 2016, we launched the Fourth Industrial Revolution Fund, very tech focused, very focused on these future technologies that are really driving that Fourth Industrial Revolution. We also launched our FANG Plus Fund, which has exposure to the FANG stocks, that's your Facebook, Amazon, Alphabet, Netflix, and Google. In 2020, we continued innovating and we launched the Health Innovation Fund. And now this year in 2021, we are launching a number of products, but the ones that I'll be able to tell you about today is we are launching an emerging markets ETF that's coming really soon. We today have launched our global ESG ETF, which I will chat to you in a little bit more detail a bit later today, and we are launching a healthcare focused ETF, which is very, very exciting. Healthcare again is another theme, so it's again thematic investing, another theme that is playing out at the moment because we do find ourselves in a pandemic, but there are many reasons why we believe that it's a theme that will continue to play out due to the aging populations that we have, especially in the developed world. And when it comes to ETFs, Sygnia is the largest provider of international index tracking ETFs that are listed on the JSE. And we have a long-term track record of managing these ETFs. I mentioned a little bit earlier that it's really important to have a good market maker. And our market maker is a company called Jane Street. They have offices all around the globe, main offices in New York, London, Hong Kong, and Amsterdam. They're able to trade around the clock, and they trade on average $21 billion worth of global equities, bonds, and ETFs. So Jane Street is our market maker, and they ensure that in the market we have tight spreads and very deep markets. Now, ETFs, as I mentioned, are passive investment instruments, and passive investing in general has become, very, very popular over the last number of years. And there's more and more investors that are looking to include passive strategies in their investments. And I'm referring to both institutional and retail investors. And with passive strategies, what's really important is, and what I intend to show you with these graphics that I have included, is to show you that the fees are lower, but from a performance perspective, they have also won the performance debate. Costs are the only thing that we really can control upfront. We cannot control what investment markets will do tomorrow, what they will do next year, what will happen in the markets going forward. So we don't have a crystal ball to tell you whether the market will be up or down when it closes today, but what we can control as investors is the cost. And from a performance perspective, if we had to look at history and we look at various surveys of how active managers have stacked up relative to passive managers, well, the proof is in these numbers that I'm showing you today. So these graphics have been taken from the Standard & Poor's survey, and what it shows is how in various regions the percentage of active asset managers that have been able to outperform an index. So we can see that in the United States, over a 5-year period, more than 75% of funds underperformed the benchmark, which is the passive benchmark. So another way to interpret it is, had you been invested with an active manager, well, there's a 75% or more than 75% chance that they actually would have underperformed passive indices. In South Africa, the picture is not very different. Over a 5-year period, more than 93% of active managers have underperformed. Over a 3-year period, it's close to 88%, and over a 1-year period, just over 78% of active managers have underperformed the benchmark used in the survey, which is the S&P South Africa 50 index. The picture for other regions, again, not very different. In Canada, more than 98% of fund managers have underperformed. In India, over 80%. In Europe, over 75%. In Australia, over 89%. So the bottom line is that with passive management, you're not giving up performance, as you can see from the historical data. And what we do know for certain is that you're paying a lot less for your investment. So fees are lower, that is certain. And then from a performance perspective, historically, we can see that most asset managers have struggled to outperform the passive benchmarks. And if you were lucky enough to be with one of the asset managers that has outperformed, the question then boils down to, how do you pick the best performing asset managers? So if you look at this graphic, we call it our fruit salad of asset managers, we can see that there's no way of telling which asset manager will be the best performing over a certain year. So what we have highlighted, and I mean, it's not picking on a certain manager, it's not picking on any manager, but looking at Alan Gray, for example, back in 2007, they were closer to the top. In 2008, the best performing manager, then they go down closer to the bottom again. 2011, they're back on top. So the reason why I'm showing you this is, even if you say, okay, well, a certain percentage of active asset managers can do well, then my question to you is, how do you pick this asset manager? It's very difficult to choose who the best performing manager will be when you have a forward-looking mindset. And then lastly, just to summarize on why I'm so passionate and we at Sygnia are so passionate about passive management, is it makes sense. It's low fees, which we can control, so you can control what you're paying for your investment upfront. The performance has been phenomenal, which I just showed you with the S&P surveys. There's a wide range of themes and options. If you wanted to have exposure to a very niche sector in the market, well, there's likely an index and an ETF for it. Efficient and immediate implementation. As I said, you can implement really quickly on your decisions. ETFs are tradable throughout the day on the stock exchange, and top investors worldwide are opting for passive options. And looking at some of the headlines that have been on various papers around the globe, you can see how there's more and more interest in passive management. And if we just highlight some of them, I mean, looking towards the top right, active fund managers pray for turnaround as the exodus continues. Investors flee active funds at the highest rate in 3 years. MSCI says passive investing will be good for society. So it's not something that's, it's only we're passionate about. It truly is really a big movement of massive assets from active funds into passive investment vehicles. So looking at our product range when it comes to ETFs in specific, as I mentioned, today we have just launched our 11th ETF. And looking at the current offering of exchange traded funds, we currently have 11. The top block shows you the offshore regional funds, and you can track an index that is very broad, such as the MSCI World, that will give you exposure to the whole developed world. The second one is the one that we'll talk about today. So this is the S&P Global 1200 ESG ETF. So I will unpack that in the next couple of slides. If you wanted exposure to just the Eurozone, we've got the Eurostoxx 50 ETF. If you wanted exposure to the Japanese market, very uncorrelated with traditional markets, then the MSCI Japan ETF is for you. We've also got the FTSE 100 that will give you exposure to UK listed stocks, and then the S&P 500, which tracks the 500 largest stocks listed on US stock exchanges. And then we have these more specialist funds. So our global property ETF. So this ETF tracks the performance of 40 of the largest global developed market property companies. We've got the Fourth Industrial Revolution ETF, which I mentioned a little bit earlier on. So this one is very, tech focused, but focused on, new technologies such as robotics and 3D printing. It's a very exciting ETF that has performed incredibly well. We have done a webinar on this fund, and we're probably due to do another one just to keep you up to date with all of these new and exciting technologies. And then on the local side, we have two ETFs. The one tracks the Swiss 40 and the other one tracks the top 40 stocks. So out of our full suite of 11, 9 of them are focused on getting our investors exposures to indices outside of South Africa. And this is where I mentioned that benefit of being able to be an investor that's sitting in South Africa, but your investment is tracking the performance of global stocks without having to worry about exchange control. From a performance perspective, if we just focus on the 1 year, this is the 1 year performance to the end of March 2021. You can see that our ETFs have done very, very well. And specifically looking closer to the bottom, we can see that over the 1 year, our Fourth Industrial Revolution ETF has really shot the lights out, giving us 98.1% return over the year. And then our local indices have done very, very well, providing almost 50% returns over the 1 year. So really great performance from these various ETFs that we do have on offer. So now let's chat about this new ETF. So the name is quite long, but it's very descriptive to you as an investor of what you can expect should you invest into this ETF. So as the name suggests, it tracks the S&P Global 1200 ESG Index. So what is ESG? ESG stands for, the E stands for environmental, the S stands for social, and the G stands for governance. And ESG investing refers to a class of investing, also known as sustainable investing, and it's really a broad term that's used to describe investments that provide positive returns as well as a positive impact on society and on the environment. So I will unpack these ESG terms, and I will chat to you a little bit about how the index is constructed, so what's excluded, what's not included, but ESG really is the focus. So that focus on the environmental, social, and governance factors. Now, if you think about an index, an equity index, this is tracking global equities. The companies that are included in this index, they need to be doing the right things in terms of ESG. Now with the E, which is environmental, it really comes down to, are the operations of this company, adding to the problems with climate change? Are they polluting the environment? Are they, polluting the communities around them? And there's, more and more public awareness around climate change, around the implications of climate change. So it's really important that some of these big companies that, investors invest in, that they, are doing the right things when it comes to the environmental aspect. And there was a poll of professional investors, and when they were asked which one of these 3 factors, the E, the S, or the G, would have the largest implication on returns going forward, it was, according to the poll, it was really the environmental factors that are most likely to drive returns in the coming years. So climate change has been something that has been, really the focus of many, many governments, and there's more and more pressure on, companies to really be doing the right thing when it comes to their business operations and to make sure that they're as environmentally conscious as possible. Then on the social side, so the social side is really all about how a company treats its employees, its customers, and again, the communities around where they operate. And you can appreciate how these social factors really can influence the financial performance of a company, as well as the public opinion that, clients and investors have of that company. So things such as labor strikes or protests, they really can have a big implication on a company's operations. These, strikes or protests, they can damage a company's reputation, but they can also impact profitability. So it's really important, for us as investors to know that, the companies that we invest in won't be caught up in some type of, scandals where either their staff or customers or generally communities are protesting about them. Another part of the S in ESG on the social aspects is how the employees are treated and also the working environment of the employees. So is it a safe working environment? Are there any safety risks? And of course, companies that provide a safe and healthy, good environment to their employees, they do face less volatility in their businesses in general. And then, as I already mentioned, even the online public opinion of the company is part of the S in ESG. And online public opinion of a certain company or certain company's practices can have a major implication on the long-term consumer preferences. So if there's a very negative opinion about a company, then over the long term, that company is not very likely to be very successful and then in turn very profitable. And of course, we want to invest in companies that are growing and then are profitable so that we can enjoy a good investment return at the end of the day. And then the last factor of, the E, the S, and the G is the G. So G stands for governance. And, locally, if I think of governance, first thing that pops into my mind is sign-off, and how bad governance can really have major implications on an investment. So if you had to invest in a company with bad governance, it's very likely that that company will be involved in some sort of scandal, and ultimately the share price will tumble and your investment will suffer in return. So two big global examples that a lot of you are most likely familiar with would be the VW emission test, that scandal, and then the Facebook misuse of data. And these, news articles that go out about, these scandals do really create a lot of damage. But governance is, not just about, the public opinion is very important, but it's not just about the public opinion. It's also about, the structure of the company's code and their values. Are they transparent when it comes to their reporting? Do they have any cyber risks? So there's a lot when it comes to governance, but it's really important that the companies that, we as investors invest in, that they tick the boxes when it comes to the governance factors. So that's what E, S, and G stands for. So when it comes to this new ETF, it's an ESG ETF. So it tracks the S&P Global 1200 ESG index. It will give you as an investor exposure to the same risk and return characteristics of the S&P Global 1200 index. So the broad index is the S&P Global 1200, and the index we're tracking here is the ESG, which I will explain over the next slide as well. So all of the companies that we will track when we're tracking this ESG index, they do tick the boxes when it comes to ESG. And again, just to summarize some of the key characteristics on the environmental side, there's a focus on, is there waste and pollution, resource depletion, greenhouse gas emissions. Is the company, involved in some type of practices that causes deforestation or climate change? On the social side, as I mentioned, it's about employee relations and diversity, it's about the working conditions of the employees of that company, about the impact on the local communities around them, health and safety, do they provide a safe environment, how they deal with conflict. And then on the governance side, it's about, the tax strategy, how do they remunerate the executives, about, donations, public lobbying, corruption and bribery that we know, all too well about here in South Africa, and about the board diversity and the culture of the organization. So this ETF will come in at a cost of, we are targeting a total expense ratio of 35 basis points. So goes, to my point about passive and low-cost investing. It's a great way to gain that global exposure to companies that tick the right boxes in terms of ESG, all of these factors that I'm showing you here, and it comes in at this very low cost of a total expense ratio of 35 basis points. So how is this index constructed? So firstly, as I mentioned, it will give you as an investor similar risk and return characteristics as the global 1200 index. So the S&P Global 1200 index. So if you start with that index and you exclude companies that are involved in controversial weapons, in tobacco, in thermal coal power generations, and you can see some of the details I've included in this table. So all of these companies are excluded. So if a company is involved even through corporate ownership and generates revenue from the sale, for example, of tobacco products, they will be excluded. If they're in the business of nuclear weapons or controversial weapons, they will be excluded. So all of these companies are excluded. Companies that are also excluded from the list are companies that have a low United Nations Global Compact score. So the bottom 5% are automatically not eligible for inclusion. Then you have the remainder of the stocks. Now, the remainder of the stocks that have not been excluded based on these characteristics each have an ESG score. So this ESG score is done by analyzing their environmental, social, and governance practices. And within each sector, because this index is trying to give you the same type of exposure as the broad global 1200 index, within each sector, so if you think about financials or industrials or telecommunications, within each sector, the top 75% of ESG scores within that sector are then included in the index. So that's just a little bit of background as to how this index is constructed, and just to tell you again that you can expect a very similar risk and return profile of this index to the non-ESG broad index. To give you a taste of some of the holdings that are sitting in the top 10 in terms of market cap, you see that if you had to invest in this ETF, you would have exposure to a lot of these bigger household names that we're all very familiar with. The top holding accounts for about 5% of the portfolio, and the top holding as at the end of March was Apple. Now, Microsoft, Amazon, Facebook, we know these names all too well. From a sector perspective, the largest allocation at the moment is to information technology. So you can expect to have, just over, 22% exposure to the information technology sector, and that's followed by financials, healthcare, and communication. So those are the large sectors. The index is rebalanced annually. And of course, as other industries, for example, as they grow, you may find that if you look at the portfolio next year, this time, maybe a different sector will be the largest sector that you will have exposure to. From a regional perspective, it is a global index, so it includes exposure to more than 30 different countries. But the largest exposure that you would have as an investor would be to the US market. About more than 60% of the exposure is to the US market, but there is exposure to Japan, to the UK, to France, and to emerging market nations such as Brazil, Mexico, Peru, and Colombia. So this is just to give you a taste of what the top 10 holdings have been like, and you'll see in the third column, we've also included the returns of these individual stocks over the last year. And I mean, tech has done particularly well, especially through the pandemic, and we can see that the returns of some of these holdings have been phenomenal over the 1 year to 31 March. What I love about ETFs is that you can get exposure to a number of different stocks, the whole index essentially, but you don't have to go and buy each one individually. So it's a great way for investors to start with even a very small amount of money and being able to get that, broadly diversified exposure that, cuts across various sectors in the industry. So, with one ETF, in this specific one, you can have exposure to, as I said, various regions from the United States to Japan to some emerging markets, but at the same time also to various sectors. There's healthcare holdings in here, there's information technologies, communication companies, consumer companies. And if an investor had to purchase some of these stocks individually, it will take a very, very long time to build a very well diversified portfolio, and it would cost a lot of money. So just looking at the top 10 again, I mean, Apple Inc. was selling at, more than $122. Amazon, more than $3,000 per share. So if you had to buy all these shares individually, just looking at this quickly, it would cost you more than $8,000 just to buy the top 10. Whereas to get that same exposure, you could buy one instrument, and that one instrument will track the performance of that full index. So it really is a great way to start with a very well diversified basket of securities. Let's look at Apple and ESG. So Apple is the top holding. We're all familiar with Apple. A lot of us, have Apple iPhones or iPads, or might be even listening to this webinar this morning on an Apple device. So very big holding, accounts for about 5% of this index. And the CEO said that they believe that businesses at its best should serve the public good, should empower people around the world, and binds us together as never before. So what do they do from an environmental perspective? Well, they have a very ambitious goal to be carbon neutral across their entire business, including products, by 2030. So in the next 9 years. They try to adapt, to innovate, to try to combat climate change, and they want to use the planet's finite resources to safely make their products with safer chemicals. On the social side, they say that people come first. They really try to have a very inclusive and diverse workforce, which is very, very positive. And they do believe in fundamental human rights for everyone. And then on the governance side, they tick all the boxes in terms of governance. That's why they are in this index. And it comes down to having principled actions, informed and effective decision making, and to consistently monitor their compliance and performance. So this is just an example of one of the holdings in this fund. But you can expect that all of the constituents in this index are ticking all the right boxes in terms of ESG. In terms of long-term performance, can you expect ESG funds to actually perform better than just a traditional index? So what this chart compares is the long-term performance of the S&P Global 1200 ESG index. So this is the index that the ETF that we're discussing this morning will track, compared to the broader S&P Global 1200 index. So you can see the white line represent the index that we'll be tracking in this ETF. And you can see that since about 2019, it is slightly outperforming the broader index, but it is moving in line with the broader index, which is exactly what we are telling you you can expect. You can expect to have the same risk and return characteristics, but over the long term, there's many studies out there that show that over the long term, really this focus on the environmental, social, and governance factors of companies, these are the companies that can sustain themselves over the long term, and they are likely to do much better over the long term going forward. So the CFA Institute published a research paper on the ESG findings. And if I just touch on some of the key aspects, they studied whether the impact of specific ESG issues impacted stock performance. And the findings were that there's a huge body of evidence for positive impact on performance. The overall impact of ESG performance on the stocks, there is material evidence that shows that ESG factors can lead to superior performance of companies. When comparing ESG funds to traditional funds, there was no clear evidence to suggest that 100% ESG funds perform better. Today there may be many funds out there that are not necessarily ESG funds, or that don't claim to be ESG funds anyway, where the performance has been good. But what we are saying is that it is important over the long term to have this focus on ESG, as we do believe that over the long term, companies that tick the right boxes in terms of ESG will perform better. But the study of historical evidence, you can say it neither suggests yes or no. And then in other asset classes, there's solid evidence of better credit ratings and lower spreads in corporate bonds, and a positive impact on credit risks and the performance of sovereigns. So for an individual, if you wanted to invest for your own personal portfolio, your own savings, why would you as an individual want to choose an ESG investment? Well, investors are becoming more and more conscious of where they're investing and the impact that their investments are having on both society and the environment. So some investors do it for moral reasons, but they also believe that rewarding good values of companies do support a company's long-term performance. It's also seen as a risk mitigation tool. So by investing in a company that does all the right things in terms of ESG, you can see it as a risk management move. On the flip side, if you had to invest in a company that's notorious for, unsafe working environments, for example, could be oil spills or, just polluting the environment, then it's really not a good investment at the end of the day. And you can expect that it probably won't pay off in the long term if they continue to cause scandals and they're all over the papers. And investors, especially today in the information age, information is at our fingertips. And as investors, we are demanding more and more of companies. We're demanding more of these huge corporations that are very big, very profitable, and that can actually have a much more positive impact on society going forward. For the institutional investor, on the other hand, so institutional investors are investors such as insurance companies or big banks or retirement funds, so big pension funds, big provident funds. Now, just by their pure size, institutional investors, of course, can invest, many, many millions into a certain asset. So it's important, because they are big in terms of assets as investors, that they are responsible. But at the same time, it's not just the size that matters, but at the same time, if you think about a retirement fund represents the savings of a lot of employees that don't necessarily have that first say in where exactly their retirement fund savings are being invested. So compliance with, international and local regulations is one of the reasons why institutional investors are looking to ESG investments. They're also looking to improve their risk and return profile. So as I mentioned, you could, view ESG investing as lower risk because these companies aren't involved in polluting or in big scandals and with governance issues. And then big institutions can promote sustainable development in their business practices. For institutional investors, there are, various policies out there that try to encourage ESG investing. And not just in South Africa, but governments worldwide are increasingly focused on sustainability. And back in 2012, with the Code of Responsible Investing in South Africa was only the second country after the UK back then to formally encourage institutional investors to incorporate ESG into their investment decisions. So I hope this shows you that ESG is not just a buzzword that we're using now, and it's not just, something that we've, people have just thought about. ESG investing has been encouraged in South Africa for a very, very long time. And, I mentioned this when I spoke about, even just individuals asking more of companies. There has been a cultural shift, and it really comes down to, us as investors saying, I will support this company, I will, buy shares in this company, but I do want them to do good in society. And it can be seen as a risk mitigation, tool. ESG good companies that are doing all the right things, they tend to be more resilient in times of crisis. They can avoid expensive scandals. So if you think about the VW emission scandal that I already mentioned, that cost more than $33 billion US. The Facebook data scandal cost $5 billion US. So of course, a company that's not doing the right thing, you can also expect them to impact their bottom line, because these scandals, unfortunately, do cost money. And because there's such a drive towards, more sustainable investing, I mean, you have the momentum effect. So the more and more people that want to go into these sustainable investments, that drives up demand and prices. So I will touch on a little bit on some of the legislation, especially in South Africa, for the institutional investors. I'm not going to go into too much details on these points, but the regulations are there, and institutional investors in South Africa are encouraged to invest sustainably. So I will touch on, Regulation 28, requires environmental, social, and governance considerations to be taken into account by retirement funds before investing in a certain asset. Then there's the Code of Responsible Investing in South Africa, which I mentioned a little bit earlier on. There's the principles that are embodied in the United Nations Principles of Responsible Investment. This is the UNPRI for short, that you might be more familiar with. And then there's Guidance Note 1 of 2019 that was issued specifically for retirement funds. And just to touch on, CRISA, so that's the Code of Responsible Investing in South Africa. Well, what does this code say? They say that an institutional investor should incorporate sustainability considerations, including environmental, social, and governance, into his investment analysis and investment activities as part of their delivery of superior risk-adjusted returns to their beneficiaries. So they do encourage sustainable investing. Then Guidance Note 1 that was issued in 2019 for retirement funds. Well, this is a big one. Not only are they encouraging, retirement funds to invest sustainably, but the regulation says, this Guidance Note says that each retirement fund needs to write into the investment policy statements how the retirement fund intends to research the various assets that they invest into, and the extent to which ESG factors have been considered by this retirement fund, and the potential impact of such factors on the assets of the fund. So simply speaking, each retirement fund must in their investment policy statement say exactly how they have chosen the assets to invest in and whether they tick the boxes in terms of ESG. So ESG, serious consideration for retirement fund trustees as well. And this ETF really makes sense for us at Sygnia Asset Management. There's quite a lot that we do in terms of ESG just in our day-to-day practices. And if I can just touch on a few of the things that we do at Sygnia Asset Management, where we act as a multi-manager. You'll know that we have some multi-manager portfolios where we employ the likes of some single asset managers in South Africa to manage portions of those portfolios, and we make sure that all of these managers have documented ESG policies in place and that they adhere to these policies, which is really important. We look at their proxy voting records, and we continuously have conversations with them around their engagements with the corporates that they are researching. We are very big passive investors. As you saw in my first couple of slides, we're also very passionate about our passive investing. And as passive investors, we also, indirectly become big holders of certain securities. If we're tracking the SWIX index, for example, and we have all of our clients' monies that we are investing with tracking that index indirectly on behalf of our clients, we do become, quite big investors in certain companies such as Naspers, for example. So we thought that it would be responsible to vote our proxies even on our passive solutions. So even on passive solutions, in collaboration with our active managers, we do vote our proxies there. And then on the credit side, ESG is, fully integrated into the investment process, and we do engage with the industry around social, green, and transition bonds. So we do take ESG very seriously across our, product range, and that is why launching a global ESG ETF, such as the one we've just launched today, really makes sense for us at Sygnia Asset Management. And what's coming next? So I did touch on the fact that we are launching another 2 ETFs this year. So the next one that you will see from us will be an emerging markets focused ETF. Now, the specific index that we will track will be the MSCI Emerging Markets 50 Index, meaning that as an investor, you can expect to have exposure to 50 of the largest, most liquid emerging market stocks. On a look-through basis, this is very heavily weighted towards China and the Asian economies, which is very positive, as these are the economies that are really set to grow over the near term. And these are the Asian economies are the ones where the middle class is growing. They're seeing large population growth, but specifically the middle class. And we know it's the middle class that's really consuming. So we're very, very excited to launch this ETF. And then the other one I mentioned a little bit earlier on, that we believe that healthcare is a big theme at the moment. We do find ourselves in a pandemic. It's not yet behind us. So there's a major focus on healthcare companies. Just by watching TV, we all know all too well about AstraZeneca and about Pfizer and about Johnson & Johnson. And we know all about the various research that's being done. But it's, even looking beyond the pandemic, there's so much innovation happening in the healthcare space. There's also use of artificial intelligence to simulate training environments. There's 3D printing that can be used to print a human ear, tissue, various organs. So there's so much innovation in this space. Couple that with the fact that experts are saying that we might not be lucky enough to wait 100 years for the next pandemic. Again, there'll be a big focus on healthcare. And already now, healthcare is such a huge spend of each country's GDP. And this spend is only set to increase as we can expect these kind of, pandemics or epidemics going forward. And then lastly, I mentioned that a little bit earlier, but we do have aging demographics. And, as people age, we are able to keep people alive for longer thanks to all of these medical advancements. So the focus on healthcare is really not just about what's going on now, but really looking ahead and wanting exposure to healthcare companies. And what you can expect out of the ETF is the ETF will track the 150 largest developed market pharmaceutical companies. And we are in talks about potentially a few more ETFs. So stay tuned, keep your eyes on our social media pages for any teasers or announcements, but we continue to innovate and we continue to think about exciting new products for all of our investors. So I want to thank you all for listening to me for the last hour. I will have a look and take a few questions. But if we don't get to your questions, I do encourage you to keep typing them. I will have a record of all of these questions. And if I don't get to yours today or live now in the sessions, then what you will receive is you will receive a written response from me after this webinar. So the first question says that the SIG ESG is not yet available at my stockbroker. It should be today, as it is trading on the Johannesburg Stock Exchange. Do we have to wait for a minimum period of 3 to 6 months for a track record before having access to this new ETF? So you should have access to this ETF today. So it is there. In terms of track record, of course, we don't have a track record as this ETF is only launched today. But if you wanted to look at historical performance, I encourage you to just have a look at S&P's website. So you could just, even if you just Google S&P Global 1200 ESG Index, you'll find a lot of information on that specific index, what the performance has been like. Since the inception of that index. You can also have a look at the top 10 holdings that I showed you here, and you can even read a little bit more about the index methodology. So I touched on how certain stocks are excluded, the other stocks are ranked according to their ESG scores. If you wanted to look at that in a lot more detail, then I do encourage you to log onto their website and to continue look at our social media pages, where we will share a lot of information as and when we start getting an official track record of this ETF. There's a question that just says, what are the fund manager's costs? So as I mentioned, we are targeting a total expense ratio of 0.35%. That will be the total expense ratio of this new ETF. It says, based on your ETFs on offer, the one question I'm reading, the local property ETF is not on the list. So we don't have a local property ETF. We do have a local property index tracking fund, but it's not available as an ETF. It looks as though the S&P Global 1200 ESG ETF is very similar to the Sygnia Itrix MSCI World Index ETF. So that is true from an exposure perspective. Both of them are giving you this world exposure, very much skewed to the US market. As I said, with both of these, you can expect to have, more than 60% of the holdings are US holdings. The difference with the 1200 is, of course, the ESG element. So that environmental, social, and governance factors that I spoke about. So that's the difference. And then the cost of this ETF is also lower than the MSCI World ETF. So on the question of whether you should switch to the new one, it is a personal preference. The exposure, as I said, is very similar in terms of, that global exposure as well as the sector exposure. Both of these ETFs have the highest weighting at the moment to information technology, but if you wanted and you felt passionate about the ESG element, then I would say that the new one is for you. Another question on the total expense ratio of the new one, it is 0.35%. Says this fund overlaps quite a bit with the FANG fund. It is a market cap weighted index, meaning that the largest, most valuable companies have a bigger weighting in the index. That's what a market cap weighted index is. And of course, we saw the largest holdings at the moment are very tech focused. So you could say that it does have an overlap with the FANG fund, which is true. There is exposure to Facebook. We saw Apple, so very similar holdings, but of course the FANG Plus fund is more skewed towards these big five, whereas this, we saw that the largest exposure was to Apple, which is only 5%. So it's a very, very well diversified mix if you consider all the constituents. What I didn't mention in the webinar is currently there's 753 constituents. So when I explained how you start with that 1200 index, you exclude the companies that are involved with controversial weapons and tobacco and thermal coal. You exclude all of those. You exclude the low United Nations Global Compact score. Once you exclude those, and then you start ranking within each industry, and you take the top 75% best ranked ESG scores, then at the moment, you really have exposure to about 753 separate constituents. Will this ETF be available on other platforms? Yes, it is. There's a question on the fund composition and if it's a market cap weighted index. Yes, I can confirm it is a market cap weighted index. The geographical composition, I did touch on this, but it's more than 60% US, and then the next biggest geographical exposure is about 6% to Japan, so they're much smaller, going down from that. And of course, there is developed and a little bit of emerging markets exposure. I mentioned the Brazils, the Mexicos, so you will have exposure to those type of stocks as well. Is there consideration for this ETF to be Regulation 28 compliant? Unfortunately, Regulation 28, or I don't know if I should say unfortunately, Regulation 28 is there to protect retirement fund assets, and Regulation 28 really promotes a very well diversified portfolio across various assets. So in the regulation, you can't have more than 75% in equities, you can't have more than 30% offshore with an additional 10% into Africa. So there's all those percentages, but all of those rules are really there to protect you as an investor, to make sure that your asset manager is not taking all of your money and putting it all into one share, for example. So it's really there to provide diversification. It's there, that diversification is also a risk management tool. So this is 100% global equities. So this ETF gives you exposure to global equities. So unfortunately, it is not Regulation 28 compliant. There's questions whether this recording will be available. So this recording will be available for you to listen to. If you registered and attended even just part of the webinar, then you will receive an email to thank you for your attendance, and in time you will see a link to the recording. Will this be available for tax-free investments? Yes, it will be. So there's quite a few more questions. Instead of going through them one by one, I'm afraid that I may, repeat a question that has been posed twice by two different attendees. So what I will do, it's already, we've been through our 1 hour. So what I will do is I will close off this webinar, but I will take the remainder of the questions, as I said, and I will answer you all directly via email. I want to thank you again for listening to me this morning, and I do hope that I provided some clarity with regards to what ESG investing in is and what you can expect from investing in this new ETF of ours. So thank you very much.